Inflation comes in under control, and the market doesn't know how to act. Let's talk about it today on the Weekly Update. Okay, friends, inflation came in tame. Now what? Let's talk about it. So, first up, here's what you need to know. Surprisingly, there were no surprises with CPI. Now, this is interesting because most recently, the economic data has been surprising one way or the other. Most recently, surprising to the downside. So we saw weakness in PPI yesterday. We saw weakness in things like retail sales, weakness in things like employment rate, jobs numbers, etc. And so what was interesting about this CPI report, there were no surprises. Things came pretty in line. And the market was somewhat braced for inflation to come in pretty weak here. Here's the number specifically. So this is the way we've been looking at CPI all along. Blue is everything together, including of food and fuel. Crimson here is the Fed's preferred way of looking at inflation, so-called core inflation. And what you notice is for the month, we came in at 0.2 exactly on expectations. And year over year, headline inflation has now dipped below 3%. So this is a significant milestone. Although core inflation still remains spicy, still above that 3% number, and that's more important for the Fed. Basically, what we have going on here is gasoline deflation and goods deflation, so goods are getting cheaper, but services and housing continue to remain sticky, continue to remain elevated in terms of inflation. So an inline number, but if you got into the details, maybe there were some things you could pick apart this report. So it's not as good as things might see. And what you notice is, at least in May and June, we're coming off of some pretty significant disinflation, some disinflationary trends. So this was a little surprising that, we didn't continue that disinflationary trend that we had. Market, for the most part, didn't know how to take this one. So what I'm showing you here, this is the US 2-year Treasury. And this is a good read on basically what the Fed is going to do. They're almost mirror images of what they will do, the 2-year and, the Fed expectations. So if we look at prior to the report coming out, there was an expectation of rates coming down. So this was, sort of like building that anticipation of a weak CPI data. The report came out and rates sort of broke to the upside in, kind of a violent way. So this was, as we were looking at the CPI data, we were expecting weakness. When it didn't come through, the market was pricing in, we're a little bit over our skis here in terms of expecting the Fed to be cutting a whole bunch. If you remember, that's what we've been talking about, economic soft patch. So the Fed is going to cut very aggressively starting in September. And this movement higher that you see here on the chart was basically the market saying, this CPI tells us that rate cutting may not be as aggressive as we otherwise thought. And then today there's been a whole bunch of flop and chop after this, certainly because of, these wild moves. We're going to see, movements like this on the yield side of things. So what does this all mean? Inflation's tame, now what? Well, surprisingly, there were no surprises in the CPI report, but I think the biggest impact of this is aggressive rate cut expectations. So the thought that the economy is weakening very rapidly, and so therefore the Fed is going to ride to our rescue. Those aggressive rate cut expectations are now being priced out, and the markets are flopping around because that rate rescue that we were anticipating may not be coming as quickly. This was a large part behind the small cap move. This was a large part around the broadening of the market. If rate rescue isn't coming as quickly as we previously thought, then what that means is that kind of like that older regime, the Magnificent Seven, big cap tech, quality, I think some of those trends stick around for a bit longer than we were thinking. So we are not heading to the casino anytime soon. And then I kept this point up here just as kind of a reminder, we are still in the economic storm. So nothing about what the CPI gave me today, nothing about PPI, nothing about last week, the jobs number tells me that the economic storm is over. I think we're still here. But what you see in economies very often is that it's sort of like the tides. It's like the waves, right? There's going to be a wave where things look really bad. That was, last week and the week before it. And then it sort of recedes a little bit. So you say, okay, everything's fine. And then maybe a next wave comes in. You say, things are bad again. And then maybe it recedes and everything's fine. So I don't think we're out of this economic storm yet. We didn't really have any data this week that told us, hey, the economic storm is getting worse, but I still think we're in it. I don't think we're in the eye of the tornado or anything like that. I think this is normal action. As the economy gets weak, it tends to come in waves. And the way that you know the trend of the economy is we never sort of like retake our peak or start moving back on the upside. It's just sort of like things get bad, then relief, then bad, then relief, and we sort of like ratchet down lower. So that's where we are. No surprises this week, and in some ways, maybe that was a surprising result given all the activity that we had in the previous 2 weeks. I'll see you this weekend for the markets review. See ya. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.